Welcome back to VIX 201. And before we dive into the math, let's take a quick look at where we are in our volatility weather cycle. And so far, we know the market moves through 4 distinct climates. The sunny region, VIX below 18, contango above 0. The cloudy region, VIX from 18 to 20, low to mid contango. The rainy region, VIX from 20 to 30, curve flattening or inversion. Monster storms, VIX above 30, deep backwardation. And today we explore my absolute favorite climate, the sunny region. The sun shining, the S&P 500 climbs smoothly, spot VIX sits quietly below 18, and the future curve sits in static contango. And our shadow player, VXF30, sits well above the spot VIX. Now, let's guess how a long VIX ETF like UVIX will act tomorrow. Tomorrow arrives and spot VIX doesn't move a single point. It stays completely flat. But time keeps ticking. Those future umbrella guarantees lose value every single hour because there's no rain in sight. M1 and M2 futures slowly slide down towards spot VIX. In quantitative finance, we call these futures converging to spot. And this is why holding long VIX ETFs on flat sunny days feels like holding ice in your hand on a hot summer afternoon. It simply melts away. And ETFs like VXX, UVXY, and UVIX lose money day after day, even if the spot VIX doesn't fall a single point. On VIXinsight, the higher our VXF 30 basis spread, the steeper the mountain, and the faster futures roll down towards spot. And that exact same time decay that destroys long ETFs become pure compounding profit for short ETFs like SVXY or SVIX. And during the quiet VIX period from 2016 to 17 in our database, SVXY gained a massive 700%. And even after the 2020 pandemic crash, when SVXY's leverage was reduced to a safer minus 0.5x multiplier, it still delivered a smooth 300% compounding gain over the following 2 years. And now, before we go any further, let me clear up a very dangerous misconception. Do not fall into the trap of viewing long VIX and short VIX as two symmetrical sides of the standard market where prices simply fluctuate up and down, and you think you can just buy the dip on long VIX ETFs. While short VIX enjoys this massive compounding run, long VIX ETFs enters an endless nightmare. And just look at this chart, we called it the inevitable slide to zero. And because of the constant contango low yield loss, holding long VIX ETFs long term is a guaranteed 100% way to burn your capital, and there are no exceptions. You will see lower highs and lower lows day after day, month after month. The daily downward friction multiplied by 2x leverage on products like UVIX accelerates this converging loss velocity. So never ever buy and hold long VIX ETFs as a long-term investment. They are built purely for short-term tactical hedging, not long-term holding. Now let's pause for a critical reality check. This isn't just a simple cozy fairy tale. And there is a hard quantitative truth we must address. In the sunny regime, short VIX returns are not strictly positively correlated with the daily VXF30 spread on a single session basis. A steeper slope creates macro potential energy. And that is an indisputable statistical truth over time. But daily market performance is chaotic. And here's a note on quantitative rigor. In our research, we strictly analyze today's spread to tomorrow's 1 SVX return. We never use the contemporaneous today's spread to today's 1 SVX regression, because matching today's spread against today's return is a look-ahead bias trap that offers zero actionable trading alpha. And to understand how daily returns actually behave, let's expect the data on VIXinsight. And here we go. When we filter over 2,000 historical contango days with spot VIX set below 18, plotting next day 1 SVX return shows a wide scatter of both positive and negative sessions. And short VIX ETFs do not go up in a clean straight line every single day. And while we're grouping data into 1% spread intervals, yields noisy erratic averages with no clear linear pattern. But when we classify the VIX-30 spread into three structural tiers, low contango 0 to 5%, mid contango 5 to 27%, and high contango above 27%, the signal becomes crystal clear. Low contango. Contango compression signal underlying equity friction and an unstable choppy tilt, causing a 0.64% average on SVX bounce. And mid contango is the true sweet spot. One SVX smoothly decays at an average rate of minus 0.10% per day. For high contango, extreme curve tension triggers mean reversion spikes. And you might ask, wait, minus 0.10% daily on SVX decay? So for SVXY, that's only 0.05% daily growth. Isn't that too slow? And please do not ignore the frequency. As shown in our lower pillar chart, mid contango accounts for over 88.63% of all sunny regime trading sessions. And it is this relentless daily water dripping through stone persistence over 88% of the time that compounds into 300% to 700% mega chance. And currently I'm working on adding a dedicated interactive analytics module into our advanced lab on VIXinsight, so you can expect these exact spread distribution bins and regime frequencies in real time. And later, in our upcoming VIX ETF 301 series, we will dive deep into how to build automatic execution protocols around these exact sweet spots. Stay tuned for that.